Hello folks, Lance Martin, Coldwell Banker Town & Country, and we are here for our second edition of our monthly market forecast or market snapshot. We did our first one last month, so here we are in August 2021. If you didn't see last month's, we're going to archive all these. You can click on the links and you can find last month's, and frankly, moving forward, you'll be able to find all of them. I'm going to do it a little bit differently than we did, so if you did see what we did last month, this is going to be more of a condensed version, just because I don't want to spend every single month taking 20 minutes explaining some things that I'm going to assume are understood. So, at any rate, we're going to go ahead and get going. Today, what we're going to be talking about is inland Southern California real estate market. Generally, the three counties where my offices are doing business: LA, Riverside, San Bernardino County. We do some stuff in the other counties, San Diego and Orange County, but for the most part, this is what we're primarily going to focus on. So if you need some help in some of those other markets, I have all that data. Just reach out to us and we'd be happy to share it with you. In addition to that, we're going to talk a little bit about interest rates. Not a lot has changed, but if anything, they're still low and actually have improved over the last 30 days. So we'll take a few minutes and talk about interest rates. Quite honestly, the big topic on my mind today is the eviction moratorium. Let's date stamp this. Today is August 5th, 2021. A lot of stuff going on in this past week. So we're going to do a completely separate segment on the eviction moratoriums. If that's why you're here, quite honestly, you can skip this video, go to our part 2, if you will, and we're going to do a completely separate and distinct segment on what's going on with the eviction moratoriums and how that not only affects landlords and tenants, but quite honestly, how it may affect you with your real estate, even if you have no intention of ever renting your property. It's impacting everybody, whether you realize it or not. So that'll be a completely separate segment. And then I'm hopefully going to be able to introduce the interview. Last month, if you were paying attention, you might have tuned in this month to say, hey, we're going to interview Ido Benzivi with Highland Fairview. Ido and I's schedule are still conflicted, so anyway, stand by for the interview. And my plan is, quite honestly, once a month to bring you a full-length 45-minute, 60-minute interview with an industry leader. That's what we're really trying to accomplish here. So we're going to go ahead and jump in, and we're going to start with our market update. Start with median price. Los Angeles, Riverside, San Bernardino counties. Okay, these are the three counties, and these are combined. So the data I'm going to share with you are those three counties combined. This is the part that I said I wasn't going to repeat myself much from last month's video. This information is coming from Broker Metrics. They pull it out of CRMLS. Okay, I could explain that for an hour. I'm not going to do that, but that's where the data is coming from. So what do we have here? We basically have a 2-year chart. I know on the video sometimes some of these bars get a little washed out. So the washed out bars are months for over the last 2 years. The darker bars, the darker green bars, are basically what we're going to focus on. The middle bar there is July of 2020. The far bar over there to your right, my left, is July of 2021. And basically what we're looking at is we are looking at a 25% increase year over year in LA, Riverside, San Bernardino County in median price. Just absolutely nuts, all right? Now, again, I could say a whole bunch of great things about that, and if you own real estate in these counties and you've experienced a 25% increase, which is entirely possible you have, you're probably pretty happy. Long run, though, this is a little bit of a challenge. So we need to be a little careful and kind of tamp some of our enthusiasm with these very, very high year-over-year appreciation numbers. But anyway, so here's the three counties. You can see a fairly steady run, which, by the way, also unusual to see property values basically, for the most part, they increased every month in the last 12 months. Looks like a slight pullback here in January of 2021. But I will tell you, that's not normal. Okay, it's not unusual to see, this is a little bit of a flattening, but it is not unusual to see an ever slight pullback in median property values starting in maybe September, October, November, and then we start to ramp back up. So to see a chart which is basically a month-over-month increase is actually unusual, and to certainly see a 25% annual appreciation, equally unusual, extraordinary, I would say. The next number, again, same three counties, Los Angeles, Riverside, San Bernardino County. Similar chart, same data sources. By the way, if I'm going to throw up some cautionary flags today, I'm going to start right now, all right? So red bars are supply of inventory, basically active listings that have hit the market. if you've been paying any attention to this, and frankly, if you're watching this video, you're someone who pays attention to this, you are very, very well aware that we have an inventory problem. Not only in Southern California, I just got back from a trip in Alaska and I felt like I was talking to my people here in Southern California. Same exact challenges, and I'm hearing this all over the country. But at any rate, that far right bar there where you see an ever so slight pullback, what that means is there was less listings on the market in the month of July than there was in the month of May. So this is the deal. I have a bunch of anecdotal evidence that says we're starting to see inventory increases in my neighborhood where I live. If I didn't look at the data, I'd say, guess what? There's more listings than there was a month ago. And frankly, the reality is there are more listings than there were a month ago. But my market isn't, or my neighborhood is not the market. So in the 3 counties combined, let's just call it Greater Southern California minus Orange and San Diego counties, we actually saw less listings last month. And here's my forecast, if you will. We're going to continue to see less listings for the rest of the year. This is the disappointing part. I was really, really hoping that we would build on what was already some low numbers here, and we would try to get up to where we were a year ago, which, by the way, a year ago, we didn't have enough houses to sell. And quite honestly, even this very large chart bar over here, that was July of 2 years ago, 2019, I was probably saying the same thing. We need more houses to sell. We need more inventory. So our inventory challenges continue. I'm going to kind of be a theme of today's update. But again, if you're looking for more inventory, specifically if you're a buyer and you've been frustrated and out there writing multiple offers and coming up short, the only hope that I have for you, and I'm going to be too dramatic here, but is there are some buyers who have gotten a little frustrated and said, "I'll forget it, I'm checking out of the market." So that might help you a little bit. So don't check out of the market. And one of the reasons you don't want to check out is interest rates, and we're going to talk about that here in a few minutes. So you might have a little bit of relief in some buyers that have gotten frustrated and said, "I'm just not going to compete in this." Unfortunately, I just don't believe we're going to see a significant amount of new inventory hitting the market. Are we going to see a new inventory? Of course we are. We're definitely going to see houses hitting the market. But this little pullback, I wasn't expecting for maybe another month. And I think that's a sign of next month when we do this, we're probably going to see a pullback in August listings as well, which is unfortunate. Which, by the way, that number represents an 18.5% decrease from a year ago. Again, a year ago, we were coming out of COVID. We had a very, very good year. If you've been following me and my forecast, last year was a great year. But again, inventory was not great last July. And frankly, we're at 18.5% fewer homes on the market this past July than we were a year ago. The under contracts, the blue bars, if you're really following along, a little bit less. We sold 1.3% fewer homes. Let me rephrase that. We put 1.3 fewer homes in escrow. Okay, buyers and sellers got together, opened escrow. A little bit of a reduction, although frankly it's been a pretty good summer so far as buyers and putting houses in escrows. And then the actual closed escrows, that's the green bar. If you can see the number at the lower right-hand side of your screen, it's 2.1% increase in sales. By the way, for those of you that are doing screenshots of this or getting your reading glasses out, the entire presentation, there's a link available to that. So you'll be able to see this and do with it what you want. So again, 3 counties, supply and demand. Again, I guess the warning I have is, I don't know if it's a warning, it's just my opinion, is I just don't anticipate to see this red bar increase, which would be the inventory that we're all looking for. And if you're a buyer, that would be the inventory that you've been waiting for. The next, again, still with the 3 counties, are month supply, surprise, surprise, less inventory, less month supply. That bar represents a 1.4 months supply in inventory. That's down 30% from 12 months ago and significantly lower than whatever it was 13, 14, 24 months ago. So again, those 2 numbers go hand in hand. Quite honestly, next month I might not even put this chart in there because it basically says the same thing, which is pretty obvious in the other. Okay, so let's take a look at the individual counties. Los Angeles County by itself, median price. Okay, if I maybe gave you a little bit of cautionary news a minute ago, don't expect a lot of new listings. Some of you might say, wait a minute, Lance, it looks like the median price in Los Angeles County actually pulled back a little bit in the month of July. Well, if you can see that, you are correct. The median price pulled back a smidge in the month of July. That's generally not what we see. It's not unusual maybe to see it pull back in September. This is July of last year. A little bit of a pullback, 2 years ago. A little bit of a pullback in August, kind of flat in September, and then we kind of saw a little bit of choppiness, and then last year, this is a little bit more common. Anyway, to see a slight pullback in July, if you wanted to go crazy about something like that and have a panic attack, well, here's the chart that will justify that panic attack. I don't believe that's anything you need to worry about. But I wasn't expecting that. Why would we expect to see a pullback in Los Angeles County when we have such a high demand of buyers and such a small amount of standing inventory? That's a little unusual. For those of you that are screaming at me, Lance, because you're using median price, it's entirely possible. Using the median price as a metric here, there are some flaws associated with it, but I've been using it for 20 years. It generally tends to wash itself out. So we'll keep an eye on that, and we'll see what it says next month. So LA County, which by the way, if you're wondering what that number is, it's $770,000 is the median price for a home in the county of Los Angeles. $770,000 a year ago, that number was $648,288. That represents an 18% increase in median price year over year. Remember the prior chart? 25% increase. So LA County did 18. So what do we got next? Supply and demand. LA County alone, supply and demand. I'm going to move a little bit faster because these charts are going to start to look more similar. We got a little bit of a pullback in the red, less inventory. By the way, that's a 21% decrease from a year ago. 21% fewer houses in LA County. The interesting part is we actually sold 5% more, that's the blue bar, 5% more than we did a year ago, which kind of makes me question a little bit. We're selling more houses on less standing inventory. However, we saw a slight pullback in the median price. Want to keep an eye on that in LA County. And then the actual properties that were sold were up 15%. So that's LA County. Oops, I'm sorry, did I go the wrong way? Okay, Riverside County, median price for Riverside County. Similar charts. Median price, flat basically. Month over month, flat. That number is $530,000 for the entire county in Riverside, up 23.3% from 12 months ago. Extraordinary numbers. The supply and demand numbers for Riverside County are, again, very similar chart. This is where I worry I lose my audience because these charts, they tend to look so similar. But the bottom line, 15% fewer standing inventory, sold 7.6 fewer homes than we did a year ago, than a July 20. It's different than LA. So if you were following along, it's different than LA. And we actually closed 10.8% fewer homes in Riverside County. Now you might look at this and say, wait a minute, I see a bunch of down arrows and the inventory is down. This looks like bad news for Riverside. It's not bad news. It's just, it is a reflection of smaller standing inventory. And I honestly think it's a reflection of some buyer fatigue. We talked about that at our market forecast, our big event that we did back in March. And I just truly think a lot of the buyers are they're just frustrated, and it's totally understandable. So again, this is Riverside County supply and demand, and the next chart is going to be Riverside County month supply of inventory. Again, the bar is fairly small, 22% less than a year ago, and that basically represents 1 month of standing inventory for Riverside. If you're looking for, I guess, a shining star, if you will, San Bernardino County. So there you go. A shout out to San Bernardino County. Their chart not only has continued to improve on a median price, the median price in San Bernardino County jumped. Certainly it's visibly higher than it was the month before. And by the way, that's 24.8% higher than what it was a year ago. And it kind of makes sense. So for those of us that follow this, this could be an affordability argument. It's more affordable in San Bernardino County, therefore there's more room, so to speak, for the prices to go up before the buyers kind of check out. So again, San Bernardino County is the winner, if you will, for median price and overall increase, not only month over month, but year over year. So if you're doing business in San Bernardino County, you probably got a big smile on your face. Supply and demand, again, San Bernardino is a standout. San Bernardino County is a standout. Of our 3 counties, and frankly, I could pull a whole bunch of other data, it's the only one where the red bar, supply of active listings, was higher in July than it was in the month of June. Still down 11.8% from a year ago, but up. Okay, that's up month over month. And again, this trend, what we see right here, this nice little line, is really what we would love to see, and we would love to see that continue. But I tell you what, I'm going to stick my neck out. I'm going to basically say what I said for Riverside and LA County. I think it's probably going to hold true for San Bernardino County. This may be the peak of active listings on these charts for the year 2021. So in other words, next month we'll see. We'll play the tape and we'll take a look and see what that red bar does. I'm predicting it may pull back a little bit. Has nothing to do with price, has nothing to do with buyer demand. But it's, by the way, the buyer demand month over month, frankly, from the beginning of the year, is continuing to increase in San Bernardino County. The buyers, if they're fatigued, well, they're still buying more houses than they did the month before and the month before. However, they didn't buy as many houses as they did a year ago. About a 6.1% decrease in open escrows, and then the closed escrows were down about 6.9. But again, the San Bernardino charts, I mean, if you're looking for upward charts, and if you define good news as an upward, trending chart, San Bernardino County certainly shows that. And month supply of San Bernardino County, again, it's still lower. That number is 1.1 months in San Bernardino. But again, all of these charts, and I realize this, guys, I've been doing these presentations. First time I've really recorded them is the last few months, but I've been doing these same exact presentations for 17, 18 years with the same charts. And I realize they can get a little bit of mind-numbing. So for those of you that are in the business, need some help with this, of course, reach out. Or if you're a consumer, because at least 50% of my target audience are buyers and sellers. If you need more help with this, of course, reach out and we'll get more specific as needed. Okay, now, Corelogic. Corelogic is kind of a big name in our industry. They're basically a big data collecting firm, and they do a variety of stuff and have a variety of different contracts. I apologize, our screen is kind of cutting my text out here a little bit, but Corelogic sticks their neck out. Okay, so by the way, some of you are going to look at this. I had a presentation 2 days ago and I used this same slide, and we all kind of, said, wait a minute, why? This screams out for more analysis. I'm going to be doing more analysis, kind of frankly spending some more time talking to the Corelogic people. I'll come back to you next month. But what Corelogic has done, and before you try to interpret this, this is nothing to do with price, okay? When you first flash this up, frankly, when I first saw this chart, I thought, okay, this is by the way, this is national. This is not Southern California, the 3 counties. This is the United States, the entire country. So when I looked at this, I'm like, this goes back to 2005 and all the way projecting out into 2023. But this is not a price chart. What this is a nationwide appreciation chart. Okay, so just real quick, here we are back in 2005. Nationally, on whatever part of the year this was, depreciation was above 15%. Okay, then it started to roll down. By the way, if this is our Great Recession. Okay, this is 0. By the way, here's our baseline of 0. So now we start to see negative appreciation. We start to see foreclosures. We start to see all of that lovely stuff that we all went through if you were a buyer or seller or homeowner more particularly, or in the real estate business. This is the great recession that we lived through, or many of us did. And we saw negative appreciation all the way through 2009. It looks like it was somewhere around 18%. Sounds about right. If you're Inland Empire, you may say, wait a minute, ours was way more severe than that. Yeah, you're very correct. Our negative appreciation was way more severe than that. But nationally, again, I trust Corelogic, so otherwise I wouldn't put their data up. It took us all the way back to about 2010 before we started to see some positive appreciation. Interesting, Adam is our video guy. Again, thank you very much, Coldwell Banker Associated Brokerage, Margaret and Chuck for letting us use the studio. But for those of us that were around, and Adam and I were chatting, and we're talking about appreciation numbers and this, that, and the other thing. And this is a long window, guys. This was a long window, and one of the reasons I wanted to share this chart with you is for those of you that are interested in the eviction moratoriums that are going on. We're going to do a totally separate segment of that. We're going to film it right after this. You'll be able to watch it today, same time you're watching this. But there's a long window in here where we saw negative appreciation In my opinion, that window could have been a lot shorter. Not that it would not have been painful. It would have been painful, and for many, many hundreds of thousands or millions of homeowners, more painful than for some of the rest of us who weren't in foreclosure or lost our home. But it would have been a shorter window. And I truly believe, and I'm prepared to be convinced otherwise, but it's going to be tough, that had we done different things with government policy, we wouldn't have seen this gigantic, run of negative equity and an extended recession if our government policy would have been different. It still would have hurt. It would have been deep. It would have been painful, but it would have been shorter. And frankly, my fear is that some of the stuff we're seeing on these eviction moratoriums are going to create some similar charts and make things last a little bit longer than I personally think they should. But anyway, let's get back to this. So our appreciation numbers come up. So this is where we are now. So I guess this is 2021, and they've got a very high appreciation number nationally of, let's call it 17.5%, okay? We just showed you charts with 25% appreciation. Okay, so our chart, Inland Empire, LA, Riverside, San Bernardino County, is even higher than that. So what is Corelogic saying? And this is the part that I hope they're right, to be honest with you. But what they're saying is the appreciation numbers are not going to be 15 or 17% next year, and they're going to be 3.2%. So they're coming out today. By the way, they just published this within this week. I think within the last few days. Again, we're August 5th, 2021. So this was published first week of August of 2021. So what they're basically saying is the appreciation party is over, and next year we're going to see about a 3.2% appreciation rate nationally. Now, for those of you that see this gigantic drop, almost psychologically it says, oh, wait a minute, we're seeing a drop. This is not property values. This is appreciation rate. So in other words, they're saying the market's going to cool off. Property values are not going to go down, but they're not going to continue to accelerate at these rapid paces that we've been seeing. With the supply and demand and the interest rates as low as they are, I kind of have a hard time buying that. I still think there's a big argument that property values will continue to increase, maybe not at 25%, but at a larger number than 3.2. So this will be one we're going to keep an eye on. I don't think I've misinterpreted what Corelogic is saying, but I will go back and do a little bit more, not a lot more research, and we will be reporting back, and we're going to be keeping a close eye on what Corelogic has to say over the next several weeks and months. Okay, so we're almost done with our market update before we get to the foreclosure moratorium. So I just want to take just a second, talk about interest rates. This is the same chart I threw up last month. This came from Freddie Mac's website. It's a little bit less than it was a month ago. Basically, 30-year conforming Freddie Mac loan, 2.8%, 0.7 fees and points. So this is your AAA platinum buyer. Great job, great credit, reserves, all the rest of that sort of stuff. That doesn't mean that everybody's going to be able to run out and get a sub 3% interest rate. But even if you're a little bruised, maybe your credit's not 800. Maybe your income isn't exactly what the lenders might want to see to put you in that AAA platinum bucket. You're still looking at fantastic interest rates. That might mean you're in the low threes or even 3.5. But again, fantastic interest rates. So my message to the buyers and the market is we don't know what property values are going to do. I don't think we're going to see bubbles and crash. I just don't see that. Talk to me in a year, whatever. But the one thing you can control, if you buy today, you can control that interest rate. You can lock in an interest rate at historically low levels. And are we going to be lower a year from now? Who knows? But I wouldn't take that gamble. So everybody in my circle, and I mean friends and family, I'm not talking clients necessarily. So if you think I treat my clients differently than my friends and family, the reality is I don't. But I'm telling you, go buy a house. Go buy a house. the price is almost secondary. So even if you think the market is hot and we're heated up, this interest rate is all the reason that you need to get out there and lock up that property and close escrow this year. So that's my interest rate conversation. So our eviction moratorium update is basically coming up next. So we're going to take a break here. I'm going to say thank you for attending our August 2021 market update. And if you are specifically interested in the eviction moratorium, probably on the link right below this. Thanks for watching, and we'll see you next month.